Bismillahirrahmanirrahim. In the previous class, we were discussing about common size analysis and index analysis. Today, we are going in detail of common size analysis and index analysis. So in common size analysis, it is simple. We will convert 1 year data to percentages. Similarly, the next year data to percentages. Similarly, the next year data to percentages. What is the procedure? Procedure is very simple. 2005, take 2005 individual item, that is cash, divide it by total assets 1223 and multiply it by 100. So what will we do? Take 1 year data, 2005, now here write percentage of 2005 percentage. Now see, first item, it is cash. What is the amount of cash? 148. Here is another item, that is total assets. And total assets, it is how much? 1223. 1, 2, 2, 3. Now what will we do? Take 148, divide it by total amount 1, 2, 2, 3 and multiply it by 100. So we will get 12.10. Now in percentage you will write 12.10%. So this is the first item. Now take the second item, 283. 283 divided by 1223. 283 divided by 1223 and multiply it by 100. So we will get 23.14. Now take the third item, 322. 322 divided by 1223. 322 divided by 1223 and multiply it by 100. So we will get 26.32. Similarly, we will apply this method to all the items in 2005. Now come to 2006. Take the items of 2006 and here 2006 percentage. Now take the items of 2006. 100 divided by total assets, it is 2044. 100 total assets, it is 2044. So 100 divided by 2044, 100 divided by 2044 multiplied by 100. So we got 4.89. See, in 2006, 4.89%. Similarly, now take the second item, 410. So 410 divided by total, 410 divided by 2044 multiplied by 100 to convert it to percentage. So we got 20.05. 20.05. In this way, take the third item, 616 divided by 2044, then 14 divided by 2044, 1140 divided by 2044, so you will get the percentages of 2006. Similarly, apply this to 2007, 90 divided by 2169, 394 divided by 2169, so first item is 4.15, 18.17, 696 divided by 2169, 696 divided by total assets 2169 multiplied by 100. So see, we will get 32.088, 32.09. They round it, so 32.09. In this way, 15 divided by total, 1195 divided by total, 701 divided by total, 50 divided by total, 223 divided by total. So in this way, we will get the percentages, the common size percentages. Similarly, this is the liability side. So take this item divided by total, this item divided by total. In this way, you will get the percentages. Similarly, for income statement, our total item, it will be sales. Sales will be total item. Just like in the previous, we took total assets and total liability plus equity. You know, total assets is always equal to total liability plus equity. So it will be the same. So now here we will take sales as a total item. So now cost of goods sold, 849 divided by 1235. 849. Total figure, I told you it will be sales. 1235 multiplied by 100. So we will get 68. See, 68.7. Similarly, 386 divided by total is 1235 multiplied by 100. So we will get 31.3. Similarly, 180 divided by total, 206 divided by total, 20 divided by total, 186 divided by total, 112 divided by total, and 50 divided by total. Similarly, for all these years, CGS divided by 2106, so we got 71.3. Similarly, 605 divided by 2106, so we'll get 27.7. So in this way, we will convert this data, all the data, from dollars to percentages. This is called common size analysis. Now, the main thing is not converting it to percentages. The main thing is to get idea from this, that cash, it was 12%, it comes down to 4.89% and again comes down to 4.15%. Now, the main thing is to get the meaning, whether cash is going down, is it good or is it bad? That is the main thing. So now here, cash comes down from 12% to 4.15%. Is it good or is it bad? So you will be thinking that it is bad, but no, it is good. Why? There was idle cash, 148,000. The balance sheet is in thousand. So $148,000 we have cash. What we did, we took 48,000 and we invested here. See, in long-term investment. Idle cash is invested in somewhere, so it will give us a return. That's why this decision is a good decision. Cash comes down because of what? Because the idle cash, the company took the idle cash and invested here in long-term investments. Because of that, cash comes down, which is a good sign that the company is now utilizing their cash properly. The second thing is account receivable. Again, account receivable, there is a decrease in account receivable. So if account receivable is decreasing, it is also a good sign. It shows that company is collecting their cash quickly from the customers. What is account receivable? You people know about account receivable. Selling goods on credit to customers. So previously, suppose our account receivable was 400, now it is 350. This is because of what? That we are collecting our cash quickly. Collection becomes fast. Fast collection. We are collecting our cash quickly from customers. So because of this account receivable, it comes down from 23.14 to 18.17 because the company make good policy to collect money from the customers. The third thing is inventory. It was 26%, then it goes to 30%, then it goes to 32%. Inventory is increasing, which is not a good sign. It is showing that our sales department is not making efforts to sell the inventory quickly. Inventory is increasing because our selling department, they are not effective. They are not effective. They are not making efforts for for selling the inventory. So when inventory is increasing, it is not a good sign. Other current assets, so a lot of things are coming, so we can't analyze this. Total current assets. So there is a decrease in total current assets. This is because of decrease in cash and decrease in account receivable. Total is decreased because of these two things. Cash is decreased and account receivables are decreased. So because of this thing, there is a decrease in total current assets. Fixed assets, from 28 it goes to 30, it goes to 32%. So it is showing a good sign. Why? When fixed assets are increasing, it is showing that the company is expanding its operations. The operations of the company it is expanding. So when fixed assets, land, building, furniture, machinery, these are increasing, so it is a good sign. It shows the sign of expansion of the company, expanding the operations of the company. Long-term investments, so long-term investments are increasing, which is a good sign because idle cash is now utilized properly. This long-term investment, it will give us return. Other long-term, so other long terms are also increasing from 9% to 10%. So it is also showing a good sign. It is also showing expansion. It is also showing other long term, there are intangible assets. So this shows that we are taking copyrights, we are taking patents, rights. So it is also a good sign. Now come to the liability side. The next thing, it is note payable. So see, note payables from 23% it comes down to 14%, come down to 13%. Note payable means we purchase goods on credit and now we are making payment. So 23% it comes down to 14%. It is showing that we are making payment quickly. Account payable, it is also showing that we are making payment quickly. It is coming down. Account payable and note payable, these are purchase of goods on credit from the suppliers. So it is coming down. What do you think? It is good or it is bad? You are making payment quickly. So from one point of view, it is good. How it is good? When you are making payment on time, your reputation is increasing in the market. In suppliers, your reputation will increase. But one point of view is this, that when you are paying money quickly, when you are paying the credit quickly, so it is a negative sign because it is showing that you are not utilizing cash properly. Take an example. Suppose this is your company A, and this is your competitor. You are making payment in 20 days, and your competitors, they are making payment in 50 days. When you purchase goods on credit, you are making payment in 20 days, and your competitors, they are making payment in 50 days. So it shows that in the market 50 days is acceptable, but you are making payment in 20 days, which is not a good sign, because your competitors, they are utilizing cash for 30 extra days. When you make payment in 20 days, they are making payment in 50 days. So they are making delayed payment as compared to you. It shows that your competitors, they are utilizing cash for 30 extra days. Their utilization of cash, it is better than you. Suppose I am A, you are B. I'm making, suppose I have a credit of $100,000. You also have a credit of $100,000. Now after 20 days, I paid this money. Finish. But you didn't pay. You will pay it after 50 days. So this shows after 20 days when I made payment, you didn't make payment. So you can use this $1 lakh cash for 30 days. So mean you are utilizing cash properly. you can generate a return on this $1 lakh in 30 days. Now come to long-term debt. So long-term debts, it is increasing from 12 to 22 to 24. It is showing a good sign. When a company is taking loan, it is showing that company want to expand their operations. So this company want to expand their operations, so which is a good sign. Equity, when debt will increase, so automatically the equity will decrease. How? Suppose 100 is total assets, 20 is liability, and 80 is equity. So when you will increase liability from 20 to 40%, automatically the equity will come down to 60%. So see, when liabilities increase, honor equity will decrease. Previously it was 80%, but when the percentage of liability is increased, so the percentage of equity, it will come down to 60%. Same is the case here. So increase in liability shows that the company want to expand their operations. Now come to analysis of the income statement. Sales, not showing anything in sales, but there is increase in sales. Cost of goods sold, from 68 it goes up to 71, goes up to 72, which is not a good sign. Your sales is increasing, but cost of goods sold is also increasing, which is not a good sign. You are not controlling the cost. You studied cost accounting. In cost accounting, we studied that the purpose of cost accounting is to ascertain the cost and to control the cost. Here is not proper controlling. Cost is increasing from 68 to 71 to 72. So when cost increases, your gross profit will decrease. So gross profit from 31 it comes down to 27. Selling, general and admin expenses. So again there is increase in this. Increase in selling expenses, general expenses and admin expenses. EBIT, earning before interest and taxes. From 16 it comes down to 10, comes down to 9.5, which is a negative sign, which is not a good sign. Interest expenses, so when you took more loan, your interest will also increase. If you will check our loans, from 12% it goes up to 24%. So when it goes up to 24%, your interest expense will increase. Earning before taxes, 15%, 8%, 6.8%. So our earning before taxes, it is also going down. It is because of cost of goods sold, increase in cost of goods sold and increase in admin expenses. Earning after taxes, so 9%, 4.9%, 4.1%. Sale is increasing, but profit is decreasing, which is not a good sign. And this decrease in profit is because of increase in cost of goods sold and increase in admin expenses. And cash dividend, previously we paid $4 dividend, now we are paying 2.4, and in 2007 2.3, which is a negative sign. Shareholders are expecting more and you are paying less dividend to the shareholders, which is not a good sign. Just a minute. So shareholders are expecting more and we are paying less, so which is not a good sign. In this way, you will analyze the income statement and balance sheet. Now come to index analysis. I told you in the previous class that in index analysis, we have data of 2005, 2006 and 2007. Now we will convert it to percentage. 2005, 2006 and 2007. Suppose first item is cash. Now, this year data, 2006, 2005, it will become all equal to 100. This is base year data, so that's why we will take it 100%. All items, 20 items or 50 items, whatever the items are, we will make it 100 because we are comparing 2006 and 2007 with 2005. That's why the base year is becoming 100. Just like here, see, 2005. So all data of 2005 will make it 100%. In 2006, what will we do? 100 divided by 148. Current year divided by base year multiplied by 100. So 100 divided by 148 and multiplied by 100. So it will become 67.6%. Same is the case of this 410 divided by 283. 410 divided by 283 multiplied by 100. So we got 144.9. Same is the case of this 616 divided by base year is 322 multiplied by 100. So we will get 191. Same is the case of 14 divided by 10 multiplied by 100. So we got 140. Similarly for all these items, this divided by this divided by this divided by this divided by this and this divided by this. For 2007, again 90 divided by base year 148. Don't take 100. 90 divided by 148 because 2005 is the base year. 90 divided by 148 multiplied by 100. So we got 60.8. Look at this. Similarly, 394 divided by 283. 394 divided by 283 multiplied by 100. So we got 139.2. Similarly, this divided by this, 15 divided by 10, 1195 divided by 763, 701 divided by 349, 50 divided by 0, 223 divided by 111 and 2169 divided by 1223. So in this way we will convert the balance sheet to percentages. Same is the case of the income statement. 2005 income statement, sorry, this is the liability side. So 2005 will become 100. This divided by this divided by this divided by this. In this way, we will convert it to percentages. And same is the case of income statement. This year income statement, it will be 100. Now to convert to percentages, this divided by this, we got this. This divided by this, we got this. This divided by this, so we got this, and this divided by this, we got this. So in this way, we will convert the income statement to percentages. So one is horizontal analysis and one is vertical analysis. Inshallah, in the next class, then we will discuss about trend analysis. So for the next class, inshallah, this topic is left, and this is our, I think, which week? This is our week number 8 to 10. Inshallah, from week 11 to 14, we will discuss, that will be our last chapter. We will discuss, inshallah, the ratios. So, inshallah, in the next class, maybe in 2 classes, maybe we will finish the course. Then I will give you some assignments. Have a good time, and if you got some problem, you can message me in the WhatsApp group. Assalamu alaikum.